Hello and welcome to Bloomberg Quint. Lower tax expenses ensured Escorts managed to maintain its bottom line. However, on the top line and the operational front, earnings were slightly below the street expectations. Let's discuss the quarter gone by with Bharat Madan, the Group Financial Controller at Escorts. Mr. Madan, thank you so much for speaking to Bloomberg Quint. I am Yatin here from the research team. Let's begin, by talking about, segmental performance. Of course, in the second quarter, we had seen the commodity costs remain higher for auto companies. So, moving ahead, what is the outlook on margins, and how do you see, the second half shaping up?
So, yet in the first 6 months, the major issue I think the company had was in terms of the sudden correction which happened on the demand front. So, which led to a lot of correction which is required to be done on the inventory front, both within the company, inside the company, as well as with the channel partners. So that's what I think was in most of the first 6 months, which has happened. In the total 6 months, we have done almost 24% reduction in the production volume, and with the sale has been down only about 8%. So that the additional 16% EBIT has come on account of operating leverage with the production going down. So that done up to the overhead definitely had an impact on the margin in the first 6 months. So even in this quarter two, we had the same impact of 52% of the margin. But now, having said that, so I think as of now, I think we're sitting on a pretty decent inventory level. So we don't think that going forward in next Q3 and Q4, there'll be a need for the requirement of any more cuts. So which means your margin activity will look for some improvement in the second half of this year.
Okay. And Mr. Madan, what about the other business segments, ex-agri? How do you see the railway and the construction equipment business doing?
So railway obviously has seen pretty decent growth, and we continue to grow at 20% plus level, I think, which is the trend we've seen so far, and that expect will continue in the second half. So on a full year basis, we expect a decent recovery to happen on the top line front in railway business, and the margin more or less will be maintained, even though the mix in the new product segment has been going up significantly now in that category. And this quarter also, with almost 42% sale coming from the new products, so the margin is slightly low. But still, the mix of the product overall has been decent enough, and we've been able to more or less maintain sustain the margin at 19-20% sort of operating level. So we expect the similar margin number will be maintained in that segment. Now, the construction equipment front, even though the demand scenario hasn't really been great, so there is an issue being faced from the liquidity fund, from the NBFC space. Financing is becoming an issue, and still the most of the money with the major infrastructure which is still stuck in government has not been released. So that has been impacting the demand really in this segment, and it's the main issue, 30% sort of degrowth year on year. So, but overall, still, I think given the demand scenario, the company has been able to cut down on the cost. The commodity price from now, the price increase has been taken, the mix has become favorable. We are moving to a high margin products really sale, which really has reduced or breaking a level in this segment. So in spite of the lower volume by almost 20%, we are able to improve the margin, in this product, and that trend will continue going forward too.
Okay. And Mr. Madan, if you could share the numbers in terms of the current capacity utilization and how do you see it moving ahead? You said that you are expecting utilization to improve, and probably that operating leverage will help you improve margins. But what is the current operating level at the utilization front?
So last quarter, the utilization level was about 70% on the tractor front, compared to, if you look at really the last year, which was mostly running at almost 95-96% utilization level. So the next 6 months, I expect the utilization levels will improve, so that will really help in the getting the margin better.
Okay. And sir, we have just completed the festive period, a large portion of that. How have been the sales in the Diwali period? Are you satisfied with the monthly performance and the sales in the first week of November so far? How do you see it moving ahead? Would you be revising your full year guidance for the industry?
See, overall, if you look at the first 2 months, September and October festival, obviously the retail has shown good growth really over the last year numbers. It's almost grown by 20% compared to the year before. But issue is, I think with the last year, the season was extended till November. So Diwali actually was in November. So really, to look at the 3 months together and then compare that number with November, the Diwali was beginning again in October this year. So November may not be as great a month as it was last year. So that's why we really waited, watch and look at the entire 3 months period. So, but I think our expectation is more or less it should be at least a sort of flat sort of number, or very marginal growth may happen, but nothing beyond that. But given the scenario what we're seeing in the first 5-6 months of the industry, I think the flat industry in this scenario looks good.
Okay. And sir, one final question on the commodity front. We have seen steel prices come off from the Q2 highs, and in general, commodity costs have softened. So, are there any plans to pass the benefits to consumers, or more or less, this will be added to the margin trajectory that you're talking about, which could be improving moving ahead?
See, on the tractor front, we are not really seeing major benefit coming in from the commodity side. There
Okay.
is some correction which has happened. It's not really significant enough to really take a call whether it can be passed on or not. And but now we've seen some upward pressure coming, especially on the rubber prices. The tire companies are actually pressuring to increase the prices in third quarter. So overall, we expect probably it will get made up. A very marginal, maybe deflation will be there, which will be roughly maybe less than 0.5% in terms of overall sale price. So we'll have to really wait and watch and see how the competition behaves, and if the market really takes a call to pass it on, maybe we'll also have to really pass it on.
Okay. Okay. Thank you, Mr. Madan, for speaking to Bloomberg Quint and taking out the time.
Thank you.
So that's the management of Escorts, confident of margins improving moving ahead, expects a flat to marginal growth for the entire FY20 as far as tractor industry volumes are concerned. The stock almost 1% higher as we speak. We'll take a short break, come back with the F&O show on the other side.